All right, let's dig a little deeper into the markets with our next guest, Peter Krause, who is the chairman and CEO of Aperture Investors. And Peter, it's good to see you. Good to have you in person here. Let's jump off of some of the things that Mike was just pointing about. When it comes to a soft landing, you are a bit skeptical. You don't think it's really that easy of a landing.
Yeah, I don't think soft landings are highly probabilistic. Can it happen? Of course. But I think the market continues to underestimate the strength of the Fed's conviction to fight inflation. And inflation doesn't come down that quickly. I mean, if we go back and look at time periods of inflation, it takes not months but years for inflation to actually resolve itself. So it's really unlikely that the Fed is going to reduce interest rates within the next 18 months. And I don't think the market's fully digested that. And that's why you see the volatility of rates being as high as they are, and why you see the market trying to get ahead but not being able to maintain that momentum. But, you know, we also have an unemployment rate today that's 3.4%. That's remarkably low. And if we have that much employment in the country, it's very hard to have a recession. So there's some real chance that you can have a modest recession or a real growth slowdown, and that's what the Fed is trying to engineer.
Meaning it's going to be painful, but not for everyone?
No, I think what's going to be different here than what we've seen in the last 20 years is this is going to be a more extended cycle. You know, in 2008, the world fell apart, but within 9 months, it sort of came back. And in 20, it was a 3-month, kind of decrease and then recovery. This is likely to be a much longer cycle because you've got to beat inflation, and that takes time. And that means the Fed is going to have tightening financial conditions for a while, and that's going to reallocate capital. You're going to see levered companies try to refinance. That's going to be challenging. We'll see defaults. We haven't been through a cycle like that that's gone over 18 months or a reasonable time period for a while.
So what do you do as an investor in that environment?
Well, I think, look, I've always, whenever you answer that question, I always sort of answer from a longer term point of view, because trading is not really investing. So, the idea that you shouldn't buy equities here because they're expensive or because they might go down really doesn't make any sense. At the end of the day, it's a reasonable entry point to own the market right now. It's below 4,000. Over the next 2 years, the market's going to be higher for sure. And it'll probably earn more than the fixed income markets will.
We're below 4,000, but just barely. With the gains from today, you're going to put yourself there. I mean, is 4,000 a turning point for you? Is it that important to be above or below, or are you just saying in general?
No, just in general. Yeah, in general. In general. And I think the point was made earlier about the consumer stocks and the industrial base, which had underperformed last year, which is now performing better. Utilities and interest-sensitive securities like REITs are having real challenges. So there are places to actually put money in the market that have reasonable returns, reasonable multiples. Are multiples going to expand like we saw in the last 2 years? No, because interest rates are going to stay high. They're not going to let those multiples go.
I mean, that's a big question.
Because they shrunk pretty dramatically already. So no, you're not going to see a lot of shrinkage. So that means that stocks go up because earnings go up, and that's what we'd like to see, as opposed to multiple expansion.
I mean, maybe not normal for the last 20 years, but that's normal
exactly right.
Pre-20 years ago.
Yeah, pre-20 years ago, you bought stocks because their earnings grew. You didn't buy stocks because their multiple was going to go up. That was an extra. You didn't buy stocks at high multiples expecting the earnings to shrink, the multiples to shrink. So here, we're in that market where earnings are going to matter, and then differentiating between stocks will make sense.